Hi, I'm Patric Palm, CEO and founder of Favro, and this is the Learn from Leaders podcast. The background to this show is that Favro customers are some of the most innovative companies in the world. Enterprises wanting to be more agile, software as a service companies scaling fast, and game developers and publishers wanting to master live ops. So we get to know some truly inspiring leaders in product development, marketing, operations, sales, executive management. And what we do here is that we interview them about leadership so we can all learn from them. Let's go. And we are live with John, and I was going to say John but he wears many hats, but taking the shirt, I think we can safely say that, node.vc is a main hat today. But, for the ones in the audience that don't know you, maybe you can just give, the more personal story, maybe to, what brought you to what you're doing with Node right now, because it's been quite an extraordinary journey.
Well, thank you. So my background is really as an entrepreneur. Obviously now I'm a full-time venture capital investor. I've been so for a bit more than 4 years now. But before that, I started with studies in engineering physics, spun off a company from the institute, and then another company from the same institute. Took that public, and 20 years as an entrepreneur, maybe want to do something else full time. And I had actually done a lot of venture capital related things, raised a lot of venture capital, done some angel investments, done some fund investments alongside together with the other VCs, and really existed in the ecosystem for quite a while. More and more transactions, and now I'm doing kind of transactions only and the associated support with the companies.
And I think we can say that one of these companies that you built is Toby, but that became an interesting story because it became two companies on the stock market. How did that happen?
Yeah, I don't know. Maybe I can count myself as a founder of two publicly listed companies, I guess. I mean, I wasn't part of the separate listing that they did end of last year, but obviously I was part of the initial phase and the build-up of both to kind of the business units that are now separately listed. But the brief background is really that I was working with sensors, and especially signal processing or mathematical modeling on the sensor signals. I had some sort of innovation around that led me to start my first company, and then the second company, Toby. Got some really strong, good colleagues, recruited an awesome team, and built the company with a great company culture. So we were founded in 2001, which was a pretty tough time to get venture capital. So we had to very early be profitable, actually, even though we were doing very, very heavy tech stuff, both software, hardware, and some complicated stuff. So that in itself was easiest to do by doing business units with very, very clear customer value in the products. So we gradually built those business units, and they grew apart somehow. Some business units were really with one customer category, one business model, and others were with a completely different customer category and different business model. So eventually the group structure really didn't make sense. So they decided to list the accessibility business unit separately. So that is now Tobii Dynavox. So that's its own listed entity on Stockholm Nasdaq.
So you have been fathering two listed companies. It's not many people that can say that. And I think one of the super cool things about Tobii, apart from the fact that this kind of split made us at Favro get two clients instead of one, which we of course love. But another thing which is really cool is that when I do my angel investments, one of my criteria is that I want to invest in something where I feel it's bound to happen. It's something that just needs to happen. And I think what's cool with Toby is that I don't think it's super hard for you and your colleagues, with the people you've been building this with, to explain why this truly is something which in one way or the other is going to be happening in the future.
I think you're absolutely right. On sort of a philosophical level, man-machine interactions become more and more common. We depend more and more on our machines. We're carrying smarter gadgets and we're spending more time in front of the screen. We're expecting our cars to do more for us as well as other things. And just we're expecting devices to be more intelligent. And that intelligence that we expect from the machines has for many years been really built up with megabytes and megahertz and basic compute, so they can do extraordinary things. They can do things that we can't even remotely do with our brains many times in terms of just sheer calculations. But on the other hand, they're still very, very dumb. I mean, you can be reading a document on your tablet or on your computer, and the screen shuts down because it doesn't even know you're there. That's in human context, that is being really, really dumb. Like you don't know what's going on at all. You're completely ignorant to what's going on. So adding the capabilities, the senses to machines really makes sense, right? How can you let somebody let go of the steering wheel even for a brief second without making sure that he or she is really paying attention to what is important, right? So knowing what you are doing, who you are, where you are in space for creating the right 3D impression or just deploying the airbag at the right height. For example, I mean, we are expecting this from our machines today. So yeah, on that philosophical level, you're right. I think many people get that point, especially the ones with sort of a tech heart or ambition. But on the other hand, when you come with a fairly expensive trinket that is eye controlled, you have to explain why people need it. But that's how we've done that with Toby by our business units. Specific business unit targeting a specific customer category.
So I'm going to go out on a limb here now, with the risk of asking a very stupid question, but this is a question which is relevant to ask you, and that is that: will Minority Report happen?
No, it will not. For the sake of, if you actually imagine that specific type of interaction, I think for some viewers, listeners, we have to explain that, because it's Tom Cruise basically doing all these gestures. So it's gesture control, and I'm not saying that gestures are fundamentally bad in every single way, but what the evolution of man-machine interactions will be, according to me, is that the machines will understand more and more subtle things. We call it passive interaction. So you're not doing an explicit interaction. For example, I'm looking at you now. I'm not doing it to control anything, but machine could know that, and it could make sure that this window is refreshed and that it stays on. For example, like these things, they're not deliberate actions, but they're passive interactions. But I also think on the active interactions, the typing, the clicking, the pointing, the gestures, that they will be minimalized, so that you, instead of these very graphical Hollywood-style big gestures, they're very cumbersome, and they're not really following the trend of getting as much done with a few clicks as possible, getting as much done by kind of a simplified. So no, I'd say no. Actually, maybe it looks great and it's great for Hollywood, and we've heard the analogy before.
It sounds like what you're saying is that it will actually be better. But yeah,
it will be better than, yeah, absolutely.
And I think we have to get back to that conversation some other time, because we have a very important thing to discuss today. The theme of our conversation today is what makes a great investor. And I think this is interesting because I've been having investors on this show before, and then we typically talk from the investor perspective on market trends, what makes a good entrepreneur, things like that, right? And and I had a chance to have a deeper conversation with you around this, and full disclosure here for the audience that I'm a little bit biased because LP in Node here, but you had a very interesting take on what makes a good investor, and of course, as an entrepreneur, I'm then thinking, okay, cool, someone who really have been thinking this through is probably who I would like to work with. But I want to get into that topic and can I just hear you out on your thoughts on this?
Yeah, I mean, where to start? I raised venture capital from an industrial institutional investor back in '99 for my first tech company. So I was 21. I dropped out of engineering physics studies at the Royal Institute of Technology and started a company. And they had some real qualities as an investor. Also, some things that I struggled with, being a young entrepreneur and then being an older organization in many ways. And then it went on. We started Toby, and we brought in some of Europe's best VCs. But I think even though they did a great job and they supported us well, I was always we managed to find the investors that had a bit of operational experience. So when you bring in investors, you on one hand you bring in a potentially a venture capital firm and a fund with all the colleagues and everything that comes with that. But on the other hand, you bring in an individual. And that individual can be great, and the firm can be an issue, or the other way around. You have to see both, right? So we were able to find some individuals with a strong operational background. It was always easier for me to reach the right conclusion, many times the same conclusions, but with investors that had a bit of operational experience. So I always wanted that, and I also saw kind of after my first few fundraisings that in the US you have investors many times with more operational background, successful entrepreneurs that have spent a good 10, 15 years building companies. Then after that, they decide to become full-time investors, and they can do that from a position of understanding, relating, and supporting, of course, the investees, the companies they invest in. So I always thought that was something that we were missing in Europe in general, and in the Nordics especially.
How would you? I mean, the perspective that you have today, is in a context that you've done so much, right? So if you would kind of go back to I think you say you were 21, right?
Yeah.
You would go back to like your 21 yourself, and you would be able to coach that and say, okay, these are like the top three things, or whatever list you want to have. You would look for in an investor, because I mean, it's almost like a cliche statement, but as a good entrepreneur, you should choose your investors. But if you're going to choose your investors and not just take whatever check that comes, then you need to have some kind of evaluation criteria, right? So again, if you're going to go back to that 21-year-old version of yourself, what would you recommend?
Oh, really thinking on my feet now, because I think first thing, you should definitely find an investor with whom you share the same agenda. I think this is very, very important. I did not know this until, quite late, actually, to be honest. But the agenda is really important. Like, what kind of company do you want to build? What kind of risk are you willing to take? And what is your time frame? And what is your sense of what does a successful valuation mean for an exit? If you can share that agenda with the investor, I think that's a very, very good starting point. And very few entrepreneurs think enough about this, if you ask me. So it's also probably one of the main reasons to decline an investment. You see a great company, but investors many times talk about this is not really a VC case. First of all, I don't think anything is a case. It's a company, somebody's life creation, but it the point that they're trying to make is to say, the ambition, the risk appetite here, the risk reward, it's not really what you were aiming to do. You might be very happy with 20% year-on-year growth with very little risk, and you might need a little bit of money, but after that you would rather keep it for life, this company, and kind of live off of the dividend. And then obviously you will have a disconnect. So first of all, the advice would definitely be to make sure that you share the agenda. I think then my second advice, I wish I could keep this as my third and last, because I think it's the most important. It's to pick an investor with whom you want to share the room when shit hits the fan. So it's not, you shouldn't really expect your investors to do anything specific for you. Expect to do all the work yourself. Obviously, they can open doors. They can help you in fundraising. They can coach you in a lot of strategic perspectives and such. But the best attitude is really to expect to do that work yourself, but expect to have somebody by your side when shit hits the fan that you've chosen, right? Because things will, happen. It will go incredibly well, or it's going to be really bad, or it's somewhere in between, and you still have to make tough decisions. And who do you want to have in the room then? So I'd see it more as choosing a partner than choosing an investor, and I think that is important. And then maybe, the third one would be to make sure kind of that they have the capacity to follow on, to double down if things go well, that you have like a good dialogue, that they're open and clear. Those would be, kind of like main things that I would want to tell my 21-year-old self.
So let's get back to the second one you had there. So how would you know? One way to know is, of course, that you have already done one journey together and you have been through that roller coaster, and you know that this is someone you do want to be in a partnership when the shit hits the fan. So that's one way to know, which I think is one of the reasons why you see so many situations when investors are basically investing in the same entrepreneur over and over again. But now we're going back to your 21st-year-old self. So this is your first journey, how could you, find out?
Yeah, I think you actually know more. It's about also where you put your trust in the different feelings you're feeling. Like, should I go for the highest valuation, or should I go with the ones I like working with? And I think the truth is really not just that black or white, maybe, but definitely stress test the investors. And if you have mixed feelings for how they work, or if you feel that the culture is not a good fit, then you trust that feeling as well, right? So I know that I interacted with certain investors. I entertained those dialogues for a long time. I eventually did not take their money, and I'm so happy I didn't. I went with other people that I really like working with. So I think my first company didn't do at all as well as Toby did. And one of the reasons was at Toby we had a very, very good dialogue between the founders and the investors. We had a very open, good friendship. We could talk about anything. As a company, you want to have investors that you can go to, tell them about the shit that just happened and talk to them about how to deal with it, rather than go to your colleagues, talk about the shit and strategize about how to tell the investor. That's the main difference. So if you feel that you're interacting with somebody that you would actually tell, okay, this just happened. I just screwed up major. How do we fix it? Because end of the day, the investor and the entrepreneur, they own this part of the same company. Many times it's more or less the same share they have, right? It's the same upside they're sharing. So success should be for both, right? So there should be a very strong alignment on on just making the best for the company and the development.
So let me then ask you a follow-up question on that. So we're getting into the potentially controversial areas here. Then
yeah, great.
You've been seeing things from the outside when it comes to VCs for a while, and now you have done more than one journey as an investor yourself. What have you? How have you seen things change to the better? And I'm going to throw in a little bit of spice into it because I had a really good conversation with an investor that I really like, and the conversation we had was that we said that there are some investors who have what we call a bouncer mentality. They like too much to be the bouncer in the door. And that clouds the judgment to be the kind of partner that you're actually talking about here now. Because, the stuff that you're talking about now, there's a lot of trust there, right? There's like trust, there's also being able to, have this, like, let's say, a problem solving mind when, even when you're a little bit scared. And my hypothesis is that things have changed over time. I think it was a bit different before. I think it was more the same macho attitude, in the VC industry. And I think basically business evolution have separated, the really good ones from the maybe not so good ones. But I'm interested to hear your perspective, because you have a much more kind of like high level view on this than I could provide.
Yeah, but many things have changed. It's a much nicer scene to be an entrepreneur in general. I think you're right that some of the investors with the wrong attitude, they were washed out. I mean, we in the Nordics, we lost a bunch of VC firms after the kind of 2001 bubble burst and the years that followed after that. Some stayed around, and they were typically, very much the very good people with long-term visions. And I have a lot of good things to say about Northwind and Creandum, for example, that really kind of survived that. So yeah, absolutely. I think also from kind of an entrepreneurial point of view, entrepreneurship has gone from being something only for the very few brave, exploring, doing something that was kind of not the beaten path, to be sort of like much more of a clear formula, like the stepping stones. I'm beginning of my kind of being an entrepreneur years. The A round, B round, seed round, the terminology, it wasn't really there, right? At least not in Europe or in the Nordics. So no, the things have changed. The entrepreneurs have a much higher standing now. You see VCs entertaining the entrepreneurs. You see the big VCs entertaining also the small VC. So they stay close to us small VC funds to make sure that when our companies mature, that they are in good standing. They make sure to keep their reputation well. And I've seen some of the most well-paid investors spend long hours with companies that have failed, just to make sure that they tidy up in a good way. And so being a good citizen and a good investor, I really like to see that. So I think the scene is very good now from that perspective. One thing that have happened though is that many things become very standardized. This is an A round, this is a B round. So you have much, more companies, more entrepreneurs that fall into these tracks. So sometimes it becomes a little bit too rigid. It becomes almost like a formula, and you have to follow that formula. If you raise this much money, then your valuation will be this. So sometimes I feel the need to question some of those kind of established truths that have just happened. Yeah.
So we had a chance now to talk a bit about what makes a good investor. We have only a few minutes left, and I do want to give you the chance to speak a little bit about also market view, because, really two questions. One, you're just launching Node. What do you want the entrepreneur community to know? If they're going to just know because you kind of you tend to have a, some kind of idea about investors, like, okay, this is a tier A and they're like this, and these guys are a little bit more like that, these guys like this. So so what is the one, two or so things that you want the entrepreneur community to know about Node now as Node is coming into the market? And secondly, there's a lot of fear in the market right now because of the economical turmoil, and with Favro we have a lot of inbound interest, especially from American investors, and I always ask them these questions like, well, are you actually investing in Europe? How do you feel about this? And I get a lot of interesting answers, right? And I definitely see that there's a bit of a split between the ones that are kind of waiting it out or whatever strategy they have, and then you have the ones that are still active, but probably the input I'm getting is that processes are slower today, and valuations, at least when it comes to certain kinds of companies, are lower. But also one nice input I'm getting from the Americans is they say, well, in America there was a bit more inflated valuations to deflate, versus in Europe, it was more balanced already before. Now, so maybe you share these views, maybe you have a different view, but I would just like to hear you out on these two questions.
Yeah, no, valuations have come down, not as much in the public markets though. I think main difference now is that a lot of kind of tourist entrepreneurs and tourist investors are gone, which is good because it makes it less noise. I think entrepreneurs have more respect for money. I know this from 20 years of burning through VC money, that it is. When it's too easy to get money, the precision goes down. So precision for spent money within the entrepreneurs is going to be better, and entrepreneurs know this, right? And then kind of what makes Node, right? We are entrepreneurs ourselves at heart, which means that we will, on one hand, be able to see a good entrepreneur from a less qualified entrepreneur, maybe. But we're also definitely able to support our entrepreneurs in a whole different way. It usually doesn't take many minutes into a meeting until we talk about actual business stuff. I've spent my whole life as a deputy CEO or CEO of fast-growing VC-funded companies. So you end up talking about your incentive programs, your acquisitions, your transfer price policy, or your stock option program, or anything else. And it usually, entrepreneurs that meet us know the difference. So we are real operators with real company success stories behind us. Not only Toby, but other companies with my fellow co-founders at Node. And we also know technology. We build real tech companies. So if there's technical complication in your innovation, in your product, in your stack organization, could be IP, could be software structures or hardware even, we understand that. We don't fear that risk. We don't have to run away screaming just because it has sort of a tech component and it doesn't scale explosively over like web viral, so we can handle that. And then lastly, I'd say, I think my investors that I've had in my journeys, they've done a lot of really good things for me. I'm very grateful for what they've done. But one thing specifically that they did that had the highest value back to them, and I don't know if they know this, but they introduced me to other founders. And those founders many times had even higher ambitions in terms of, conquering the world with their products than I had. So I spent time with them. I came back to the office to my two co-founders, and I'm like, guys, you can aim there, not just here. So let's do that. And it was extremely inspiring. So that's what we aim to do at Node. We have a lot of really good entrepreneurs as investors in the funds. And the ones that are not investors in the fund, we keep them very, very close. So we'll make sure that our investees get to be part of that entrepreneurial society as well.
Truly exciting, and it's again going back to the fact that there's a little bit of dark times right now. Super happy to see new initiatives. Also. Maybe some disruption within the VC industry. As entrepreneurs, we always talk about disrupting a certain market, right? And Every market, including venture capital, can and should be disrupted.
Yeah.
So that's awesome.
It's we're looking forward to that actually.
Well, thank you so much for visiting the show. Looking forward to seeing you soon again. This was a really good talk, and for all of you listening, if you like this, share it so others can take part. Thank you. I hope you enjoyed this conversation. If you did, you know what to do. Share it in your social media so more people can take part and learn. And one more thing, check out Favro Academy on favro.com for many more learnings. Thanks for tuning in.